The market is in a battle right now. The bulls think that the interest rates are going to go down next year because economic indicators are showing that we are going into a deep recession. So they're banking on the fact that interest rates are heading lower from here. But every once in a while, we get hints that this is not the case, and the fact that inflation may be here for longer. This week, it was the PPI, the Producer Price Index. So we'll review what the numbers came in at this week. We'll also be reviewing why it's important, and then we'll be looking at what that number looks like over history. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value, hit that like button. I definitely appreciate that. And if you like this type of content, please consider hitting that subscribe button, turning that notification bell on. I would appreciate that. New video every single Sunday covering the finance world. So make sure you come and check it out. And I know this PPI and CPI and all these technical terms may seem a little bit on the higher end of things. I'm going to try my best to break it down and make it as easy as possible. So let's start off by reviewing what the Producer Price Index came at this week. So we see here this Reuters article shows that the November PPI came in a bit hotter than expected. Now, what does that mean? So we have here that the PPI did increase 7.4%. Well, why is that important? The analysts, the economists, they were expecting it to only rise 7.2% this year. Now, when we take that into context and we look at the bigger picture, we can see here that it's down from the 8.1% it was in October. So when we take a peek back to take a look at how this number has performed, we can see here that it is on the downtrend. It looks like it peaked at about 10-11% back earlier in the year, and we continue to see this number head lower. So why did the market sell off this week? Well, this number came in higher than what the market had anticipated, and that's causing a little bit of a concern. So let's figure out why. The best way to do so is to understand what the PPI is, and in turn, we'll look at the CPI. First and foremost, the Producer Price Index measures the average change in a sale of prices for the entire domestic market of raw goods and services. These goods are either bought or they're produced. And why this is important is because it's a leading indicator on what the CPI could potentially be. Now, the Consumer Price Index, which we'll cover in a minute, is going to be reported next week. We'll get an understanding of what the Consumer Price Index is. But first and foremost, you have to produce the goods first. And in turn, if the production costs are going higher, then in turn, they're going to push those costs off to the consumer, which is another huge indicator by the market as to where inflation is going. So what is CPI? It's the expenditures of the people who buy goods. And what does it cover? Well, it's a basket of goods, and it measures food and bev, housing, apparel, medical care, recreation, education, communication, personal goods, tobacco, haircuts, funerals. That is what the CPI is covering. So the PPI, or the Producer Price Index, is how much it's costing to make the goods. CPI is how much it's costing to buy them or consume them. So what the market is saying is the PPI is a leading indicator. If the PPI is staying high, then the CPI in turn will be high. And what that means is that the Federal Reserve or these federal banks are not going to budge on dropping the interest rates, which means that there could be a topsy-turvy market heading into 2023. So when we look at how these two relate over the long run, we'll jump over here to the CPI versus the PPI index. And I know it's small, so we'll try our best to talk on a high level. But going back to the 70s and 80s, we do see a correlation between the two numbers. So the blue number is the CPI and the red line is the PPI. And when they continue to raise, both of these numbers continue to go. So that is definitely the understanding, is that if it costs more to produce the goods, it's going to cost more to buy them. And there is a little bit of a deviation to that over the past 22 years or so, where we see high stretches of the red line meaning that PPI kind of goes out of whack, but it definitely shows that CPI does follow. But let's try and break this graph down to see what these numbers look like in a shorter period. So we do see in this most recent time that PPI has kind of gone out of control. We've seen in the numbers of the PPI individually that they have come down, but we still happen to see a stagnant number for this CPI. But basically what we're trying to prove here is that when PPI goes higher, CPI goes higher, and when PPI comes down, CPI then does go in turn. But I guess with these market insights this week, the concern is that interest rates will be higher for longer because inflation has a potential to be sticky, has a potential to stay in these elevated range outside of neutral, which we've covered in the past. The Federal Reserve has a neutral range between 2 to 3% for inflation. And as long as it stays higher, they're going to try and do whatever they can with the overnight rate or the Federal Reserve interest rate to help curb inflation. That obviously means tightening the economy, trying to make it harder for people to get money, spend money, etc. Because they need to get inflation under control. And that is the important point of this note is obviously CPI reports next week. We're going to get an indication of what that number is, but we are concerned, and myself included, that inflation will be around for 2023. The interest rates will be higher for longer, meaning that these high interest rates are not going to go down. But when you see these people say, oh, the economy is going to fall apart, the Fed's going to act, I would be a little bit hesitant on that. Obviously, I'm not saying to sell anything. Buy good companies. Buy good companies that you use, use on a daily basis. But, I think the important point here is that we are going to expect some volatility to happen, at least for the near future. So let me know what your thoughts are down below. Obviously, I love hearing your thoughts and opinions. 2023 is shaping up to be a little bit of what we've seen over the past couple months. I hope you enjoyed the video. If you're still here with me, hit that like button. I appreciate all your support. Have a great week in the markets. Happy trading.